Cisco shares are down 5% right now in overtime, after giving lighter than expected guidance. The earnings call is kicking off shortly, but joining us now, in the meantime, CFRA Research Senior Equity Analyst Keith Snyder. Keith, want to get your thoughts on this because they guided down for the full year. It seems like there's some weak customer demand afoot, at least in their core business. But they also announced a pretty extensive restructuring plan where they're going to cut 5% of the global workforce. Your takeaway?
Yeah, guidance was very soft. $3.5 billion cut, more or less, for the full year guidance was pretty disappointing, especially where we see backlog levels. And obviously that restructuring is happening, so I'm going to be looking for some more color on that on the call. But from a demand perspective, the cut to guidance is very concerning. They did come out last quarter and say, given how much stocking there has been from, service provider customers, cloud titan customers, that there was about 1 to 2 quarters of product in their inventory that, was going to affect demand going forward. So we kind of knew going into this quarter that demand was going to be weaker. But we had hoped that backlog level was really going to support the revenue guidance that they gave last quarter. And so, on the call, it's going to be interesting to hear what they have to say about, demand from the service providers and the cloud customers, whether it is actually a lot weaker than we had first thought, and that maybe enterprise customers aren't able to, fill that gap for them as they did in the last 2 quarters.
Yeah, looking at the results here, total software revenue was flat year over year. Software subscription revenue was up 5% year over year, and total annualized recurring revenue was also up 6% year over year. How's the progress going in terms of this transition to software?
That was actually the bright spot that, from their print that we saw. Software is becoming a much bigger part of their overall revenue mix. It's going to provide a lot more stability. Recurring revenue in general is valuable. And so that is still progressing very well. But, the problem that we see going forward is that these software packages are tied to hardware in a lot of ways. So if we see a drop in hardware demand, it's kind of a leading indicator from our perspective as the company might struggle in the future to get, that software attach rate with the new hardware sales. Okay. And so while it's growing, it's not growing as well as we would hope it would be.
So, Keith, how much danger is Cisco in from competition? You look at Arista's chart, it's doing remarkably well, up over $80 billion in market cap right now, while Cisco's at $200 billion and apparently going down. Meanwhile, Juniper's getting bought by HP Enterprise to try to make an AI-fueled push into this networking space, right?
Yeah, Arista and Juniper have always been kind of biting at Cisco's heels and taking off small bites of market share here and there. But actually, the commentary we heard from Arista, last week was, while AI is is the buzzword right now, they only see about a $750 million opportunity over the next 1.5 to 2 years for them within AI. And a lot of these customers are still testing new hardware, and so I would imagine Cisco is in the same boat where the network deployments are still in their infancy, and the big spending isn't actually going to occur until 25, maybe even 2026. And so Arista did do very well, and we do think they probably captured a little bit of market share. But it's a really difficult time for all of these companies. Their biggest clients pulled forward so much demand over the last few quarters as supply chain issues, were working themselves out, that everyone has so much inventory on hand. The new limiting factor is how fast can these customers deploy before they're going to be willing to make new orders. Okay. And so that's really the commentary we're looking for Cisco.